Hello and welcome to the preparation of financial statement series. We will prepare the financial statements, income statement, cash flow statement and the balance sheet with this information given, and later on convert that cash flow statement into CFO, CFI and CFF, and also answer why is PAT not same as CFO. So the transactions, the opening cash in hand is 110,000, sold goods 50% of the stock and it is on credit. The sales is 0 in a cash flow, so therefore the debtors will increase to the extent of 150,000 because no cash has been received. And whenever there is a sale, there has to be cost of goods sold, and cost of goods sold is 50% of the stock, so 0.40 as 50% of 50%, that is 0.50, and 80,000 into 0.50, and the stock will reduce to the extent of 40,000. Salary for the period is 20,000, and let us assume that we pay the salary fully for that period, and salary is 20,000. Collection from the old debtor is an inflow of cash, and you're collecting 60% of the old debtors, 60% of the old receivable, 60%, and so the old receivable or debtors will reduce to the extent of 60%. So we can see the change in the debtor, opening debtor plus sales minus cash sales minus collection is the closing debtor. And a bad debt is a loss due to the insolvency of the debtor, so 2,000, and it is not a cash inflow but the reduction in the accounts receivable, 2,000. Purchase stock for cash, so stock or inventory purchased, 25,000. It's not an expense but acquisition of stock or acquisition of an asset, so in this case the asset is the inventory. We can also see the change in the stock over this period. Opening stock plus purchases minus COGS is the closing stock. Purchase shares of X Limited, so X shares, 15,000. Once again, acquisition of assets resulting in cash outflow, not an expense but an asset. Depreciation for the period is 50%, of the opening balance of the asset. Because it's a reducing balance method, we charge depreciation on, we charge depreciation on the opening balance or the book value, and the book value is 100 minus 50,000, so it is 25,000, and accumulated depreciation will increase by 25,000. No change in the value of the plant, so the value of the plant is 100,000 and accumulated depreciation is 75,000. Interest, because of the accrual principle, interest has to be shown 0.9%, 0.9 into 25,000, and let us assume that we pay the interest, so interest is an outflow, an expense, no outstanding. So the total expenses is 89,250. So profit before tax is equal to 60,750, and let us assume that tax is calculated at the rate of 30% on the PBT. So tax is equal to 0.30, and let us assume that the tax is fully paid. So tax is equal to 18,225. So the profit after tax is 42,525. If no information given, entire profit is transferred to the reserves. We can now find the cash in hand. Cash in hand is cash available minus the cash payment. So cash in hand is an asset, will be transferred to the balance sheet. So cash in hand and the profit, two important items on the balance sheet, depend on the income statement and the cash flow statement. Now we can close the balance sheet. No change in the capital, no change in the capital, no change in the bonds, no change in the creditor. So the summation of the sources of the balance sheet is 307,525. The summation of the assets, so assets are equal to the sources, and the sources are in this case capital, retained profit, bonds and the creditors. Now we'll use this information to find the CFO, CFI and CFF. The CFO is a cash from operation, so CFO is cash from operation. By using direct method is a sales plus collection minus salary minus the purchase of stock minus tax is the CFO. So CFO is equal to cash collection, cash sales plus salary plus stock minus tax. So CFO is equal to 48,225. CFF, in this case there is no inflow from financing, the only outflow is the interest, so CFF is also negative. And CFI, once again no inflow from the investment decision, but there is an outflow of 15,000. And if we sum this up, we'll give you the cash in hand. The closing cash in hand is 44,525. Then we'll try to answer this question that when PAT is equal to 42,525, why is CFO negative 48,225? We know that PAT is not same as CFO because of depreciation, that is non-cash item. So we add back depreciation. Because of non-operating item, that is interest, and we deducted while computing the PAT, so we add back interest. And then to find the adjustments in the credit items, we see and refer to current assets and current liabilities. So no change in creditors. So no change in the creditors. No change in the creditors. So creditors has no effect in this case. 10,000 minus 10,000. No change in the creditors. If you see the debtors have gone up. So increase in debtors, that means the goods have been sold on credit, and to that extent we have not received money, so therefore it has to be deducted while finding the CFO from profit. Similarly, the stock has decreased during the period, decrease in stock. So decrease in stock means goods purchased in the last time period have been sold in the current period. So it is plus, and the summation of this should give us the cash from operations 48,225. So when a balance sheet and the transactions are given, it is possible to find the cash flow statement and income statement, then also understand that CFO, why CFO not same as PAT. In this case, PAT is not equal to CFO because of depreciation, because of interest, because of the changes in the current assets and current liabilities. But you can see that we are only taking operating current assets and current liabilities other than cash. Thank you.